Good evening to all of you. Welcome you to today's webinar. Today the topic is intraday trading using bar chart and 20 period moving average. Because when we say intraday trading, we are going to look at smaller time frame. But before that, we will look at a bigger time frame to get some sort of the overall picture, and then come down to 1 hour and 15 minutes, and we will look at illustrations, Nifty, Bank Nifty, gold, crude, and probably one or two stocks. Now, these are simple indicators which are useful for intraday trading. So you don't need to go for something else which is complicated. At the same time, you need definitely some charting package. So there are free charts available. Investing.com is one site, so you can use that. Now, always when you use all these things, you must know that there are possibilities of some sort of whipsaws which can work against any particular indicator. If you are following a trend following indicator, normally whipsaws can create some problems. So what we are trying to do is we are trying to filter some of the whipsaws using the bar chart and 20 moving average. So that is one thing to be appreciated. Second thing is, irrespective of doing all those things, there will be some occasions where we cannot filter it, because if you apply too many filters, we will not get proper trades also. So it's a compromise between allowing some trades to falter and at the same time capturing many trades to make success. So within these parameters, we are going to see how to refine the bar chart usage, also a 20 period moving average. So first of all, let's look at a bigger chart and then come to a smaller chart straight away. Now you all are aware of what is a trend. Now trend by definition is higher tops. If you're using a bar chart, it is nothing but higher tops, higher bottoms, right? So if you have higher and higher tops and then higher bottoms, you know it's an uptrend. At the same time, if you want to catch the trend at the early stage, that is, if you want to really buy exactly at the bottom, now you may not have to wait for higher tops, but you can just look at higher bottoms. That is, if you have a higher bottom, then in that case you can just look for buying. Okay. Similarly, the reverse case applies for selling or for profit booking. Now, when we say higher bottom, basically the bar chart, how will it look like? Now, let us say now let me so the screen is gone, so please bear with me for a minute. So now, let's say this is a bar chart. Now if it forms like this, then one day it makes something like this. Now, so this is the third day, 1, 2, and third day. Now we have got a higher bottom compared to this bottom. This bottom is higher bottom. If that be the case, you can just go and buy above this high. So you will catch something very closer to the bottom of the market. Similarly, when it is falling, let us say it's going like this, it's coming down like this. Then in that case, you have a lower top, right? Lower top. So lower top, in this case, whether you wait for a lower bottom or not. So a lower top, so you can go short below this particular low. So you're trying to catch the trend little at a higher, at a better level. At the same time, you're also want another thing is that when you're using bar chart like this, then in that case, your stop loss should not be more than a particular period's range. So that means if you are going to on the daily chart, then your stop loss should not be more than a daily range of the market. So what is the daily range of Nifty right now? It's around say 150 points. 150 points is the daily range. So if you are a position trader, very clearly this must be the stop loss. So you should not have a stop which is more than 150 points if you are a position trader. Now if you are an intraday trader, if you are doing an hourly chart, if you look at what is the 1 hour range, what is the average 1 hour range? Let us say the 1 hour average range is around 45 to 50 points. Let us say 45 to 50 points is the average range. If that be the case, that you should not have a loss which is more than 45 to 50 points. So if you are trading in the hourly chart, your loss in any particular trade, in one particular trade, should not come more than 45 to 50 points. Okay. Now, if you are doing it in a 15 minutes chart, it may be even lower. It could be some, say, 15 points or so. So now you have to decide. Now this is a Nifty range. Okay. So you have to decide now what is your stop loss, and then decide the time frame. Now, if you are going to look at every 15 points stop loss, then you should be a 15 minutes trader. Okay, because you should not have a stop loss which is more than that particular bar. Okay, range. Then similarly, if you can afford 45 to 50 points, you should look at the hourly chart. If you can go for 150 points, then you should look for a daily chart. Okay, so this is clear. Now let us look at first we'll go to the daily chart of Nifty. We'll look at the Bank Nifty. We'll come down progressively to slightly lower time frames. We'll apply that same to crude and all. Okay, so now we will go to the chart. First of all, we have the of course in this case we have a crude. We'll come back to that later. So we look at the Nifty chart now. Nifty chart, daily chart. Okay, Nifty 50. We'll apply the daily chart. Now, so in the daily chart, let us say today it opened and quite stayed above the previous day high and closed also above the previous day high, which is 16,509. Approximately around the 16,500 levels is the close today, and it went above the yesterday's high. So that means suppose if you are a buyer now above this top. So now why are you going to be a buyer above 16,510? It is because now from the bar chart I told you higher bottoms and higher tops. Now you can see progressively higher tops coming through. Now market corrected itself a little lower. So on this this is this day's low. Now if this is taken off, then this becomes one bottom, right? This becomes one bottom. So now that means this is a higher bottom compared to this bottom. So since this high has been taken, now you are long. So what is your stop loss right now will be? The stop loss will be 16,375. So what is the range you went high about 16,510? That means 134 points is approximately your stop loss. That means one particular day's range should be the maximum stop loss for a position trader who trades on a daily chart. So this is what we have got it right now. So this is 150 points. Now you are long in the as per the bar chart, you are long. And of course now I've overlaid it with 20 moving average and 50 moving average. Normally the short term trend gets over if it starts falling below both 20 and 50 moving averages. So that's the general call that most of the technical traders take. So now we have got, of course, the market is much above the 20 and 50 moving averages. So we cannot at this point of time to wait for a fall up to 20 and 50. It can come, but right now we are using a bar chart to track our position right now. Now we got entered because a higher bottom was formed, and how a higher bottom was confirmed? Because it went above the yesterday above the Friday high. Because it went above the Friday high, now this bottom is now a higher bottom compared to this. So we are long. So on the daily position, you are now on the long side of the market. So let's look at the hourly position in Nifty and then come to 15 minutes chart. Then we look at the same thing as far as Bank Nifty is concerned. See, one thing we should know that the higher time frames that you go, okay, there will be better clarity as far as chart reading is concerned. Suppose if you go for monthly, it will be much better. Weekly, then daily, then comes the hourly. Now, even in the case of daily, sometimes there can be a lot of choppiness. Now, if you want to remove the choppiness, then you should just, in order to understand the trend, you should upgrade yourself to one trend higher than that. Okay. Now, if you have a confusion as far as the daily chart is concerned, the first point of check that you should have, see, because this particular point is, see, here it was confusing, here it was confusing. So if you get confused like this, then in this case you should look at what you should do. Okay. Now today it went up, right? So it went up, it gapped open. Okay. It gapped open, but it was above the Friday high, which means very clearly that as long as the Friday low is not broken, you know very well the market is going to be on the upside of the upside. So you want to trade on the upside based on the daily chart. So when you're going on the hourly chart, just look at one time frame which is above that also and one time frame below for clarity purposes. Now you have got on the long side, you know that you're going to be on the long side. So just look for long trades. Okay, just look for long trades. Now what happened is, after that there was a fall, and if you look at it, it came quite close. Nowadays what most of the this technical, I mean, like I do not know whether it's because of algo or because of this. What they do is they take out a small stop losses, important stop losses by a few points in Nifty and Bank Nifty, and then push the market higher. So this is what's happening. So you need to be careful about the breakouts that take place. So here, let's say there was a, so there has to be a follow through of the breakout. That has to happen. If that is not the case, then in this case it is better to avoid such positions. Now, let's look at this particular this one. So we know that after today's open, which cut above Friday's high, it's going to be at the long side. So then you come to the daily hourly chart. Now after it fell, now compared to this bottom, okay, this bottom is higher bottom. Okay, this bottom is almost equal bottom, right? Equal bottom. So you can afford to look towards equal bottom or higher bottom. You can afford to look towards long side. So what you could have done is you could have gone long above 16,489, keeping 16,390 as a stop loss, generally speaking. But what happened is that this is a very high range, because normally if you look at the ATR for the market, so we'll look at the we'll go and look at the average range for the average true range. So we should do only when the average true range is when the stop loss is acceptable. Now, so let's say see, this is the average true range. Now, average normal range for generally speaking, as far as Nifty is concerned, this is itself a little high. It shows as 65, 66 points in the last 10 hours or so. So generally speaking, it will be around 45, 50 points or so. But here, the stop loss is coming much more than that. See, it comes to 93 points, 93 points. If that be the case, now we should think whether we should go ahead with the trade or not. We should go ahead, because the stop loss should not be more than a normal average true range, which is more than 65 or 66 points here. So in that particular case, it is for us to decide whether we want to take such a huge higher stop loss or not, or wait for the market volatility to calm down before we go for it, right? So this is one trade that we took. Now, after that, let us say the market goes up. It goes up a little bit on the upside, right? It goes up on the upside. Then after that, if you see, here this was in high and this is a lower high, right? In the hourly chart, you got a lower high. You got a lower high. Now, when it went the lower, so if it falls below 16,499, it will look as if it has made a top for the day. So, if you had gone long also above this particular high, then in that case, this low, this lower top bottom should be the trailing stop loss, and that came at 16,499. So you might have exited with small profit, and then probably because there was 1 or 2 hours left, you could have even gone short below 16,499. You could have gone short. I'm not proposing that, because the reason why I'm not proposing is because today the high was above Friday's high. So in that particular case, whether to go short, I think it is better to avoid. You could have taken profit and just left it. Could have taken profit and just left it. But in case if somebody is doing only on the hourly chart, then for the trend purposes, I'm saying this is a higher top. This is a top. Then this is a lower top. Of course, this is a higher, this is top, and this is higher. So compared to this top is higher. But this top compared to the previous top is lower. So that means you could have gone short below this particular thing, which is 16,499, keeping 16,535 as top. That is 36 points. That is what the normal range is. So that's the normal range that is comfortable to trade. This one. So the first, if there is a trade which comes in the first hour also, normally you have a huge volatility. But after that, it settles down. So right now, if you look at it, the stop loss that's coming here is only 35 or 36 points. So you can afford to take this particular trade with a 35-36 point stop loss, and probably it closed at around 16,496, not much of a difference. So this is how you normally look towards trading as far as the bar chart is concerned. But at the same time, if you are looking at how to use a 20 moving average or 50 moving average in order to avoid choppiness, what you should do is that you should, in a slightly bigger time frame like hourly chart and all, you can use 20. You don't need to go even for 50. So what you should do is that you should wait for the market to go above the 20 moving average. Now it's like this. See, what you should do is you should allow any assets to go, if it is trading below 20 moving average, 20 period moving average, then let us say the prices are coming like this. Okay. Now this is the 20 moving average. Let us say it is like this. Then price goes up. Wait for the price to go up. Okay. Allow a pivot formation. Allow some pivot formation here. Allow some pivot formation. Allow it to come down. Allow it to come down. Then if it again starts cutting this I, then you go for a long. So this is how you try to avoid the choppiness, because some generally ask for what should be there, what should we do in order to avoid choppiness. So what you should do is that if you're using a 20 moving average, it's not that every time it just crosses over 20 moving average you go for a buy, and it crosses below 20 moving average you go for a sell. That will give you a lot of whipsaws sometimes, and probably you'll end up with a lot of loss making trades. So to put a filter, what you should do is to allow the asset prices, or Nifty in this case, to trade above the 20 moving average. If it is already trading below the 20, allow it to trade above the 20 moving average. Wait for a dip. Wait for a dip. Then if it starts cutting again above that, then in that case you go for a long. Then in this case you go for a long. The same thing applies as far as the short position is concerned. So let us say the market goes like this, then it comes down. Okay, it comes down. Then this should be considered as fresh, because there was an up move which is above 20. Now we should consider this as a start of a down move. It fell below the 20 moving average. Allow a pivot formation to happen. Allow a pivot formation to happen. Then if it starts cutting below this, then you go for a further short. Otherwise don't do that, because there is a chance it can bounce back like this. It can bounce back like this. So this is how you have to trade using a 20 moving average, rather than blindly trading that if it crosses about 20 moving average, you buy, and if it crosses below 20 moving average, you go for a sell. So this is the refinement you should bring in order to ensure that you don't get into a loss-making situation because of whipsaws. Now we will see with the help of example in Nifty itself. Now this is an hourly moving chart, right? So in the hourly moving chart, this is yellow moving average is the 20 moving average. So yellow moving average is the 20 moving average. And if you see, the first rise today was this. Okay, rise was this. Now it went up to 20 moving average. Now after that, if at all, after having come down, if it had started to move above this, we could have gone for a long, but that did not happen. Now after that it fell, right? So now, because there was one bar above the 20 moving average, we can also look at this particular low which came here. Now after it came down, okay, there's a chance that probably the market can again head towards can go up a little bit and then or crack this. So now what we are doing is, in this particular case, you can think about two ways. Now you know that this is going to be, if there is a pivot formation. Pivot formation means there has to be a lower top and a lower bottom has to happen. So if this is going to cut, let us say this particular hour is going to be cut, you presume that probably it has made a top and bottom, okay, new bottom and new top. If that be the case, then you can even short below this, which is 16,544, and put in a stop loss above 16,581 and trade it out. Because after that,
could you try again?
So if it then in that particular case, now it came down below 20 moving average. So here, if you again go above the high of this, keeping this as a low as a stop loss itself, you could have gone, because this was a fresh move. Because once it traded above the 20 moving average, then when it started to come below the 20 moving average, then this is a fresh down move. Consider this as a fresh down move. Consider this as a fresh up move. Now one of this either the pivot, this means it has to go up and come down like what I showed you in the graph, or here in this particular case it should have come and then cut above this. So both of that didn't happen. Now you can see the formation here. It has gone above the 20 moving average, right? It has gone above 20 moving average. It has also come below the slightly, so it's almost clutching the 20 moving average, we can say, in both these cases. Now if it starts to move above this particular high, which is 16,535, if it is going to start above 16,535, then it will definitely become a clear long position in the market for an up move, because it has now there is a pivot formation now. You can just see there is a pivot formation, and it just here the market today closed exactly at the 20 moving average. So it is exactly the same place where it is right now. And so if it starts to move above this particular level, then in this case we are going to see a long situation above 16,535. So this is how you use the moving average, which we will see again in Bank Nifty now, using the same moving average. Now probably if you want to go for a slightly lower time frame chart, you can do that. Now you can look at the say 15-minute chart in a 20 moving average case. Now this is the so this is the 50 moving average, right? So where did you get a pivot above the 20 moving average? You got a pivot above this, right? So this place was the pivot, right? So you could have gone long above this particular pivot, right? Okay, so you could have gone long above this, keeping this low as a stop loss. So it would have been 16,519 with a stop loss of 16,471. Now here it is coming slightly below the 20 moving average, right? So there is one particular pivot formation that is taking place below the 20 moving average. So if it starts cutting below, so it has come to a very important level as far as the 15-minute chart is concerned. So there should be this level should hold. Otherwise, it will look as if it has fallen below 20 moving average, and it can cut below that and again start moving down on the lower side. So this is a very important place as far as the 15-minute chart is concerned. It should not go much below the low of today, the last 15 minutes low, which is 16,486. So tomorrow morning, if it starts to open and go higher, then in this case you can keep this low itself as a stop loss and do the trading. So this is how you apply for different time frames, and this one. Same thing which I told you regarding the bar chart, also you can use. But bar chart, probably you don't need to go, I mean like 15-minute chart and all, there will be too many trades. I think probably in other assets there will be so many other trades that can take place. So better to stick as far as hourly chart is concerned, as far as bar chart is also concerned. But this is to illustrate to you that the 20 moving average if it is used like above 20 moving average and then a pivot cut above the 20 moving average. Similarly, if you are a downward, it should be below 20 moving average and there should be a pivot cut low below the 20 moving average for you to use the 20 moving average effectively. Now we will look at the Bank Nifty also as an example now, and then look at some other commodities also. So NSE Bank. So this is Bank Nifty for you. Okay, so this is a 15 minutes chart. Now we will look at the hourly chart or daily chart first. Now daily chart. Now daily chart in a way confirms it's a very if you look at it, daily chart is not so good. There's not much of a trend. You can see it just goes up, it comes down, all those things it does. But now it has fallen below 20 and 50 moving average, right? It has now fallen below at 20 and 50 moving average. Now if it starts literally going above the if there is going to be a pivot formation here, okay, pivot formation means, let us say if this today it has made a low, if it is going to cut this particular high of yesterday, what is this? This high is 35,376. If it is going to cut 35,376, okay, then in that case we can confirm that this is the pivot bottom. Okay, pivot bottom, and that is a pivot bottom which is below the 20 and 50 moving average, which is below the 20 and 50 moving average. That means either we are going to catch the bottom or we are going to suffer a loss of 500 points. Okay, if you catch the bottom and if you are not going to be successful, we will have a loss of 500 points. Okay, but if you are successful, probably you would have caught the bottom. Okay, from close to the bottom. Now, if you look at the average range in Bank Nifty, it is 500 points. A single day Bank Nifty average range is 500 points, which means that we are comfortable as far as doing this trade, because we are 500 points is approximately 1.5% of thing, which in Bank Nifty is a normal case. So if you can afford a 500 points thing, then only you can be a day trader as far as the Bank Nifty is concerned. So mind that. So now, if you look at this particular trade right now, otherwise you can use option for different strikes in order to reduce the loss if you want. Probably you can look at some of that aspects, but what is important is that you don't want to have more loss. You don't want to have only 100 points, 200 points loss. You can have different types of strategy. I'm not going for that. But if you're going to want a full-blooded stroke, what we call is straight 4 runs or 6, then in the case if you have to go for a buy above this particular high of today and keep today's low as a stop loss. Keep today's low as a stop loss, because it has come down below 20 and 50 moving average, and if tomorrow the high is going to be above this today's high, then today's low is going to be a pivot bottom, which means it's going to be a very, very important bottom. Okay, so now we will look at the same Bank Nifty for a 1 hour chart. See, 1 hour chart, it is clearly below the 20 moving average. Today also it did not even go above the 20 moving average. So in hourly chart, it was nothing much as far as to speak about trading on the long side at all as far as Bank Nifty is concerned today. Okay, and right now let's look at the 15-minute chart. The 15-minute chart, look at this. One time it went above the 20 moving average, right? It just went above the 20 moving average, and then there was a fall below this. So there was a fall which came down to this level, right? There was a fall which came down to this level. Now, any pivot formation below this low, okay, that means if it goes up and then starts cutting this, then it would have become very bearish as far as 15 minutes the chart is concerned. But it did not happen. After this, it started to rise. It started to rise. So then it went up, and this is the 20 move. It went up close to the 20 levels, and once it started to pick up about this, okay, then in that case we can say that to some extent we can go on the long side of the market, and probably temporarily we can keep this low as a stop loss. Temporarily we can keep this low as a stop loss, but essentially after that, if it falls, now tomorrow let us say the 15-minute chart, this comes down, then makes one pivot, like it comes down, then tries to go up and then starts cutting that low, then in this case it will become bearish. It will become bearish. So on an intraday basis, it could have been made, some points could have been made with some profits above this, Okay, that is about 35,072, and probably just close at so 40-50 points of profit could have been there as far as the 15-minute chart is concerned. So this is how you apply apply the 20 minutes chart, 20 moving average chart, as well as the bar chart for your decision. Now let us look at the same thing as far as hourly chart is concerned in the bar chart here. Now see very clearly, this is the top. Okay, this is a bottom, this is a lower bottom, right? So that means any high which is cut. Now after that it started to rally. No high has been cut. Only this is the last hour full together. So some high has to be cut. So in case if it starts moving below this particular low, which is 35,080, then I think you can keep 35,237 as a stop loss and trade the market. Now, so that means Bank Nifty, it is like this. On an intraday chart, it is like this. Below 35,235. So below 35,000, I think 80, right? So this is below 35,070. Okay, below 35,070, stop loss comes 35,250 or so, right? this is how it is, because it will be like from the bar chart point of view, this will be a lower top case. Because it's a lower top, now we presume that it can fall something more, and so we are cutting it short. Okay, that is one. Second, from the moving average point of view also, it is the hourly chart is still not above the 20 moving average also. It's still not below the 20 moving average, so it can be hit. Okay, so from hourly chart, this becomes quite a clear case of trying to go a little more on the short side of the market in case of Bank Nifty falls below this one. But if it starts, now the question is that what is the position trade? Now the position trade is if there is going to be a high cut above this high, which is 35,375, then in case a pivot bottom at this place will be confirmed, which means it can again go back to its previous peaks. So we are going to keep 35,830, 840 as a stop loss for a position trade above 35,240, 250 levels. Okay, that's all as far as Bank Nifty is concerned. So now we will shift our attention to commodities. Now let's look at the international gold price first. Now, see, different time frames have to be thought of carefully for application in different assets, because see, if you are looking at Nifty, Bank Nifty, if you are a position trader, go over a day trade with a daily chart. If you are an intraday trader, probably you look at the hourly chart. But in case of commodities, even the hourly chart, because it works 24 hours continuously, there are many portions, there are many hours where probably the trade will be done. For example, after New York closes, okay, around 1:15, 1:30 in the night of our time, then the next day till around 12:30 or 1, during these 12 hours or so, the trade will not be will be quite done. There will be some activity during the European time, in 1 and 5 of our time. Most of the activity picks up after our time of 6. So 6 to 12:30 or 6 to 1:30 is the time when the crude is quite active, and more active around 7 o'clock because the data comes. So now when you have to trade crude, I think you have to shift yourself back to, because it's a 24-hour market, it is better to consider a different time frame than what you consider for a Nifty or Bank Nifty. Generally, if you look at forex markets, international currencies, crude and gold and things, they normally look at a 4 hours chart. 4 hours chart to get a better clarity, because if you yourself see the chart, you will know that hourly chart and 15-minute chart are really choppy there. So why do you want to burn your fingers by trading too frequently? So if you want a clear delineation of the trend, okay, and how to trade it, then it is better to go for the 4-hourly chart as far as crude is concerned. Now we will look at the crude oil here with a 4-hourly chart time frame. This crude oil futures. Now we will look at the now this is the 4-hourly chart, and of course the last bottom also was below this bottom, so there's a new top that is getting formed, but we would like to see a higher bottom. So in that case we will wait for a drop and then look towards whether it is cutting off that particular high. So at this moment we would like to stay neutral in a 4-hourly chart. We would like to stay neutral in a 4-hour chart, because we need some sort of a cut and then a rise. So I think right now in a 4-hourly chart, though the crude looks good right now, I think we need to look at some sort of further understanding before we go as far as the chart, this one sell or buy is concerned. Now if you look at the 4-hourly chart here itself, in the bar chart, if you look at it, see, let's look at this particular place. Now you got a bottom here, and then you have a bottom here based on the bar chart, right? So now when it cuts this particular high, you know, this is going to be a then in that case a higher bottom is going to get formed in case if this high is cut. Now look at the once this high is cut, just see the momentum also in this particular 4-hour chart. And so you could have placed a long above this, and you could have gone for a trade up to this one. Second thing is that if you look at it, it has gone up in the 4-hourly chart. It has made a pivot here. So here, if this is a pivot made, so above this particular high, you can also go for a long. And second thing, I told you that since this is a considered up bow, because it moved from the down from down below the 20 to up above the 20. Similarly, from above the 20 it moved down below the 20. So now we want a pivot below this or something above this. So either you go long above here or you go long above this particular bar itself, because if this trend has to pick up substantially, then this particular bottom itself will tell you that this is the bottom, because if it goes a little higher and then starts cutting this, then in that case there will be a bigger fall. So we are trying to position ourselves at an early entry level compared to going long above this particular bar. So we could have gone long above this particular place. That is one. Second thing is that now if you see in the 4-hour chart, you are getting a top here, then a lower top, then a lower top. So this, since this was confirmed as a lower top, we can even go short below this particular bottom and keep this I itself as a stop loss. So that means you would have sold something very, very close to the top level itself, very, very close to the top level itself. So in crude, probably at some stage we could have even sold in the last correction up move. We could have sold at even at 68.92, keeping 69.42 as a stop loss, which is only less than 1%, less than 1%. So you are trying to get something very, very closer stop loss, while identifying patterns like this. So it's very important that you identify patterns of something like this, which is a lower top, or sometimes you identify something like this as a higher bottom. So these are things which are going to give you with that particular bar as range as a stop loss and with a significant amount of profit potential possible. Okay, so that is very, very important. And after this move, I think we have seen considerable amount of downfall happening in the market. So if you tell me how basically you will trade this market, see now let us say it is going up, right? So I do not know what the next 4 hours will be. So either if it cuts below this particular 4 hours, now this is going on right now. So let us say now it started something in this particular hour. It also it's going up. So now if it starts to cut at some stage tomorrow or later in the day or tomorrow, it's going to start cut below this particular low. Then in that case, I will go with a short below this with this particular bar high as a stop loss. The reason is now this is if it starts cutting below this, then this top would be a pivot top as far as above the 20 moving average, and so it can fall much below the 20 moving average, giving us enough profits. One. Second thing, after it falls, we will see whether it has a higher bottom compared to this, and then wind up the position and come out. So right now I will be positioning myself to look towards, now the market is going up, but I will be positioning to see whether I can go short right now. So that is how you try to catch the top, because a lot of people ask that how to catch the top and how to catch the bottom. So how to catch the top and bottom is wait for a move which is above the 20 moving average for a top, then before wait for the pivot, wait for cut below the highest bar above the 20 moving average. Wait for the cut below the highest bar below the 20 above the 20 moving average, because then probably from there you will have a significant fall. From there you can have a significant fall. Now after it comes below the 20 moving average, wait for a cut above the top above the lowest bar below the 20 moving average, which will give you the lowest that is what is the lowest possible entry, either to take profit of the short position or for a re-entry into the long position. So let us see whether we can illustrate this with a slightly smaller time frame, which we are not in favor in the hourly chart. And in the hourly chart right now, it's all it is still on the much on the upside right now, and probably we need to wait and figure out whether we only after it comes below this particular low, which is 63.30, 63.35. So at this point of time, we will not be looking at this. So now, but as an illustration, now say hourly chart. Now let us say this one it moved above the this one, right? So here it was above the 20 moving average. It moved above the 20 moving average. So what we will do is we will go for the highest bar above 20 moving average and sell below that particular bottom. See this our bottom is around 63.78. So we sell below 63.78, keeping 64.05, 64.10 as a possible stop loss, right? So now after that, it just came down, it just came down, just came down. Now here is the place where probably we'll be looking towards taking profit. Now here we will be looking towards taking profit first, because this is the lowest bar below the 20 moving average. How do you say the lowest bar? Because this high is being cut. If it is being cut, then we will say it's the lowest bar. So for what we shorted, we are taking profits here. For what we shorted, we are taking profits here. Now, what probably we will be looking towards doing this is, we will also look at whether we can go long above this. We can go long above this. Okay. Now, yes, we took the profits and we went long above that. But after that, let us say it went up like this. Then this came. Then if it starts falling below this, then this will become a lower top compared to this. This will form a lower top compared to this. So whatever we entered here, we would have exited here. We would have exited here, and probably we would have also looked towards going short below this. So now whatever small loss or profit, we would have come out of that particular position. And this particular place also, I think probably we would have come out of the position also. So so goes what we should do. Okay. So now these are the ways that probably we will be looking at it. Now once it starts to go, see, now once we have we will put as trailing stop loss, keeping always that particular hour range as this one, because now we always know that the loss that we are going to have is not going to be more than that particular hourly particular bars range, right? Say, so now this particular bar range, average range, it comes to 0.4489 or 0.45. This is the average range if it is talking about that. Then probably we will be looking only towards looking any bottom from any bottom. If it starts to cut above some $1 or so, we would have taken profits here of any short position and would have come out of that positions also. So that's the way you arrange your trading methodology, by trying to take profits of a profitable position. Okay, we're trying to take profit of a profitable position. Now this has gone up, and so we will look at the next 4 hours to go short, and also we will look towards some sort of a fall below this 63.30 or 63.25 to see what happens. Okay, so this is as far as the crude is concerned. Now we will look at the gold chart, international gold chart. Now here also we will go at the 4-hour chart first. So the 4-hour chart, so here now this is 4-hour chart, right? So let us say this is 4-hour chart. Now let us say we will be waiting for the highest bar above this one. See, this was one highest bar. Leave alone these two trading inside bars. We're going below this one. So above this yellow bar, which is the 20 moving average, you go for a short. First you go for a short. Now what happens is that after you went short, it came down 1758, 1750, 8 point difference. Now after that, if it starts to move above this, because this is a pivot above the 20 moving average, right? So let us say you are expecting the probable chance that it can cut here and then start coming down. It did not happen. So you have a 8-point stop loss which happened. But after that, you see once this is being taken off, you can see the momentum coming here. So this is 1758, took a first 8-point stop loss. Then after that it moved, you just see 1777, then here is a higher bottom compared to this bottom, so you go on the long side. Then you completely go up to this, and where do you make an exit? You make an exit below this bar, because this is a top and this is a lower top. So you are now making an exit based on the bar chart. Now here you are making an exit at 1787 bottom of what you went long about 1758. 1787 you would have come out of this position, and here once, even if you go for short below this based on the bar chart application which I told you, now this is the bottom, this is a higher bottom, this is a higher bottom. So probably what short you made here, you would have got off the position, you could have got off the position here. This is the 4 hours chart, so over a better clarity. So you could have got out of this position above this, and you're long in the market from the bar chart perspective, and also from the 20 moving average perspective, because it is now clearly trading about the 20 and 50 moving averages as far as the 4 hours chart is concerned. And I told you that if it starts cutting above a pivot above the 20 moving average, you should be looking towards going on the long side. So you're on the long side of the market also from that perspective also. So we need to wait and see the developments further to take the call here. Now we will look at the daily chart before we wind up for the day. Now gold on the daily chart, I think slowly it is now bouncing to be on the upside of the market. See, you can just see this was that last week was a big low, and right now, see, this is a higher bottom, higher top case. So this is a higher bottom compared to this. So it has started to go up above this. So 1774 is going to be an important stop loss, and it has just started to trade above the 20 and 50 moving average. So if there is going to be a pivot formation here, and then it starts moving above this high, which is 1805, 1806, it will look tremendously good for the market, because it has not crossed this green line for a long time, and today is the first time we have to wait for the close to see, and after a very long time again, ever since 16th June, 2 months, it has started to cross above this. So looking to be looking slightly good, and let's see what happens by the end of the day. Okay, now so time for you to ask questions. Thank you very much. Okay, the request has come to make a Tamil language video, so we will do that. We will do that and circulate it. So no more questions. So please kindly practice what I just told you. Then, because trading is an art of practice and perfection. So certain things we, from our experience, we say. So if you apply that, then in that case it will be helpful for you. So thanks for your participation. Hope to see you on Friday with a review of what happened in this particular month in Nifty, Bank Nifty, and some stocks. Thank you very much for participation. Stay safe. Good night. Thank you.